The $500,000 Medicaid trap, how they steal your home. Medicaid will just pay. That line costs families a house, 6 figures of savings, and months of stress. The 5-year look back isn't a suggestion. It's a clock, and estate recovery shows up after the funeral with a bill. Today, I'll expose the traps, show legal ways to protect your home and savings, and give you a 30-day plan to start the protection clock. We'll cover the look-back math, the recovery letters nobody warns you about, and the move you can make this week to freeze risk. First, let's bust the big lie before it busts your bank account. The big lie that steals your house. Here's the lie. If mom needs a nursing home, Medicaid will just pay. Not quite. Medicaid isn't automatic. You have to be medically eligible and financially eligible at the same time. And the financial rules aren't fill out a form and hope. There's strict limits, plus a 5-year look back that punishes gifts and below-market transfers. Miss that, and you can be denied for months, while bills stack faster than anyone expects. Let's talk cost reality. A private pay nursing home can run 5 figures a month in many states. Even average care drains $12,000 to $15,000 monthly in some areas. Do the math. A modest $180,000 nest egg vanishes in a year if you delay planning, and your home becomes the next target through estate recovery after death. That's why we'll deal with it later backfires. Later usually shows up as a fall, a stroke, or a discharge to rehab that turns into long-term care. Paperwork lag, plus the look back equals months of uncovered cost. The quiet weapons, 2 of them. First, the 5-year look back. When you apply for long-term care Medicaid, the state examines your last 60 months of financial activity, 30 in California during its phase-down timeline, and looks for gifts or transfers under fair market value. If they find them, they don't fine you, they impose a penalty period, months of ineligibility, by dividing the total transferred value by your state's average nursing home cost. That's how helping a grandchild with $20,000 becomes a 2 to 4 month penalty, depending on your state's divisor. The care is needed now, but eligibility is delayed. Second, estate recovery. People assume, if we keep the house during life, we're safe. That's only half true. After the Medicaid recipient dies, states must seek reimbursement from the probate estate, and in many places that can include home equity. That's the letter that shows up after the funeral. Families are stunned. We didn't know Medicaid wanted the house back. It's not personal, it's policy. And states vary on how aggressively they pursue and what counts as the estate, which is why copying your neighbor's plan is a mistake. Now, why do smart families still fall into this? Timing. The look back isn't a retroactive, oops, sorry, you can undo overnight. If you made gifts last year and mom needs care next month, you can't wave a magic wand. Paper trails matter. Bank statements matter. Deeds and titling matter. And clean documentation can be the difference between approved and penalized. Another trap, confusing eligibility with payment start. You can meet the medical level of care and still be financially out of bounds because assets weren't aligned, beneficiaries weren't updated, or a helpful transfer last Christmas just created a penalty. Meanwhile, the facility wants payment every month. Delay burns cash. Here's the honest why. The system is designed to prevent last-minute asset dumping. That's fair policy, but it punishes procrastination. The benefit of mastering this: you protect your spouse at home, keep the roof over their head, and preserve a reasonable slice of savings to support dignity and choices. Real-world impact: fewer fire drills, fewer denials, and a home that doesn't become an ATM after you're gone. What's the better method? Think seatbelts, not stunts. Start the protection clock early. Align titles with your plan. Keep a paper trail that proves fair market transactions. Separate what must be countable from what can be sheltered legally, using tools that fit your state. And no, this isn't sneaky. It's exactly how the rules contemplate planning, just not at the last minute. Implementation looks like this. Step 1, get clarity. Inventory accounts. Pull the deed, list beneficiaries, and collect the last 60 months of bank and brokerage statements you can access. You're building a proof folder. Step 2, identify any transfers, gifts, or deed changes in the past 5 years. Write a simple timeline, date, amount, who, why. It turns guesswork into a plan. Step 3, fix what you can fast. Clean titles, correct beneficiary designations that accidentally push assets into probate, and stop informal loans to family with no paperwork. Step 4, book an elder law consult to map state-specific options that actually start the 5-year clock, not wishful thinking. Earlier is easier. 5 years from today starts today. Quick, win preview before we go deeper. You can freeze a lot of risk by documenting everything now: receipts, fair market valuations, mileage logs for caregiving, and clean contracts if family is helping. A sloppy $2,000 monthly help payment with no agreement screams gift. A written caregiver contract at fair rates with timesheets can pass muster and support eligibility. And yes, if procrastination burned calories, I'd be an athlete. Most families wait. But you don't have to. There's a move you can make this week. Assemble that proof folder and schedule the elder law meeting. That single action exposes the traps already in your history and starts the path to legal protections that don't blow up the look back. Now we're ready to see how the look back actually bites and how to defang it before it does. The 5-year look back, explained like a friend. Let's make the look back simple. When you apply for long-term care Medicaid, the state rewinds the tape on your finances. In most states, they review the last 60 months. California is in a different lane with a shorter window during its phase down, but the idea is the same. They're checking if you gave away assets or transferred things for less than fair value to qualify. What counts? More than people think. Straight gifts to kids and grandkids count. Holiday checks, tuition help, Venmo transfers. If there's no fair value in return, it's a gift. Transfers for less than market value count, like selling a house to a child for $1. Deed changes can count, including adding a child to title without paying fair value. Forgiven loans count if you never had a signed promissory note with a real schedule and interest. Undermarket sales of cars, collectibles, or land count. Even paying a family caregiver under the table can be treated as a gift if there's no written contract, no timesheets, and the rate isn't reasonable. Here's the penalty math in plain talk. Add up the total value of all those gifts and undervalue transfers inside the window. Then the state divides that total by their average monthly nursing home cost, called the divisor. That fraction equals the months of ineligibility. No fine is due to the state, but you're penalized with a wait period where Medicaid won't pay. If your state divisor is, say, $7,500 and you transferred $30,000, that's a 4-month penalty. Care is needed now, but coverage is delayed. The clock usually starts when you're otherwise eligible and have applied, which is why timing matters. The thing most people miss is that small patterns add up. 12 months of $500 help to a grandchild is still $6,000. Regular $300 cash withdrawals with vague household help notes can get flagged if you can't show receipts for legitimate expenses. The state isn't guessing. They read bank statements. If you moved money like a squirrel, Medicaid notices. Let me give you a clean mental model. Imagine 2 buckets, fair market and gifts. Anything you sell, rent, or pay at market rates with documentation lands in fair market. Everything else risks falling into gifts. Your job is to keep legitimate transactions out of the gifts bucket with proof. Documentation is your shield. Keep bank statements, canceled checks, bills of sale, appraisals for property, and receipts. For cars or collectibles, Print a listing of comparable sales or an appraisal to justify the price. For rent to a family member, use a lease at market rate and collect rent like any landlord. For caregiving by a child, sign a caregiver agreement at a reasonable rate, keep timesheets, and pay via check. For loans, use a real promissory note with interest and a payment schedule, and follow it. Common mistakes to skip: adding a child to the deed for convenience, which is a gift of half the equity on paper. Selling a house below value to keep it in the family. Redeeming CDs and handing cash to relatives with no receipts. Paying for a grandchild's car insurance directly, and moving funds to a relative who will hold it for mom. All of those look like gifts unless the paperwork tells another story. Now, how do you fix history? You can't erase past gifts, but you can map them. Create a look-back timeline. Date, amount to whom, why, and any proof. Gather all bank statements for the window and tag anything unusual. If a transfer was legitimate, attach support. If not, calculate likely exposure so you can strategize with counsel. That clarity cuts weak, soften application. Quick application example. Say you helped a grandchild with $10,000 for college last year and sold your old car to a niece for $2,000 when it books at $6,000. Total transfers below value, $14,000. If your state's divisor is $7,000, you've got a 2-month penalty. Knowing that upfront lets you plan a lawful bridge for those months instead of getting blindsided mid-application. Here's the shortcut nobody teaches. Convert gifts into compliance support when possible. If a family member truly provides care, formalize it now with a written agreement, logs, and fair pay. If you rent to a child, set a market lease and collect rent properly. If you must sell property, get an appraisal and sell at market with a bill of sale and deposit trail. Paper turns assumptions into proof. If you remember nothing else, remember this. The look back isn't about punishing families. It's about proving value. Price fairly, document cleanly, and keep your proof folder tight. Once you nail that, we can handle the second half of the trap. Estate recovery, the jaw that snaps after death. Estate recovery, how they come for the house. Now for the part almost nobody warns you about, estate recovery. Here's the plain version. If Medicaid pays for long-term care, federal law requires states to try to get reimbursed after the recipient dies. They don't send invoices monthly. They wait. Then the program looks to the estate, most commonly the house, when it passes through probate. That's the letter that lands after the funeral and turns grief into a scramble. When does it kick in? After death. The state gets a notice via the probate process or death records and starts a claim. If the home is in the decedent's probate estate, it's exposed unless an exemption or deferral applies. Timelines vary by state, but expect a formal notice window and deadlines to respond. Some states record a lien during life in limited situations, but the typical surprise is a post-death claim. Medicaid paid X. The estate owes up to that amount. What's fair game? Usually the probate estate, the assets titled in the person's name at death that pass through court. That often includes the primary residence if it wasn't structured to bypass probate. Certain accounts with no beneficiary designation can land there. 2. Non-probate assets, properly set beneficiary accounts, some transfer on death tools, and trust-held assets can be outside the probate bucket, but state rules differ. That's why local counsel matters. State variations are huge. Some states recover only from probate property. Others have expanded estate definitions that reach certain non-probate transfers. Neighbor stories mislead because your cousin's clean outcome might have hinged on a rule your state doesn't share. Don't copy tactics, get state-specific advice, and match titling to those rules. Let's talk exceptions and delays. Spouse at home. Recovery is generally deferred until the surviving spouse dies. Child under 21, or blind/disabled child of any age. There are protections. Hardship waivers exist when recovery would cause, for example, loss of the primary residence to someone with limited means who lived there and provided critical care. But waivers aren't automatic. You must apply, prove facts on a timeline, and meet strict criteria. Exemptions are not the same as permanent protection. Many are delays. The claim springs back later. Here's the after the funeral story I see too often. A family thinks they're safe because the state allowed the house as an exempt asset while mom was alive. Months after her passing, a letter arrives. Our records show Medicaid paid $152,000. Please provide the estate representative's info. The kids plan to sell the house casually and split proceeds. Suddenly, the state's claim sits ahead of inheritances. If the home goes through probate, the claim must be addressed before distributions. Shock turns into fire drill lawyering. So how do you keep the house safe, legally and cleanly, without magical thinking? First, understand that exempt during life does not mean immune after death. You need probate avoidance alignment that fits your state's recovery rules. In some states, a properly structured transfer on death, TOD, deed, or enhanced life estate deed, often called a ladybird deed, can keep the home out of the probate estate and limit recovery. In other states, those tools exist but do not block recovery. And in some jurisdictions, a revocable trust won't help because the house is still part of the recoverable estate. That's why you pair strategy with state-specific law, not generic checklists. Second, match title to your plan. If your blueprint is a Medicaid Asset Protection Trust, MAPT, the deed must be retitled into the trust correctly and early, so the 5-year clock runs. If your state recognizes ladybird deeds and they fit your situation, the deed must be drafted and recorded properly with the right remainder beneficiaries. If TOD deeds are available, you need accurate beneficiary designations and updated homestead filings where applicable. Sloppy titling throws the house right back into probate. Third, maintain the paper trail. Keep taxes current, insurance in force, and homestead or primary residence filings up to date. Keep utility bills, tax receipts, and insurance declarations in the proof folder. When recovery questions arise, clean records make hardship arguments and exemptions credible. Messy records invite delays and denials. One more nuance: beneficiary designations on financial accounts. If they're blank or outdated, assets may default into probate and enlarge the recovery pool. Align them with your broader plan, trust, spouse, or children consistent with your attorney's approach, and review annually. The goal isn't to outsmart the program. It's to play by the rules with precision. Know what triggers recovery in your state. Use the right probate avoidance tools where they actually work. Protect the spouse at home and preserve exemptions you can prove. And get ahead of the timeline. It's easier to steer clear of recovery before death than to fight it after. So, how do we build the shield? We start with big picture choices and pick tools that match your state's playbook. Let's map the blueprint next. The Safe House Blueprint, big picture choices. You've seen the trap. Now let's build the shield. There are really two paths. Plan early or scramble late. Early planning is best because you control timing, paperwork, and the 5-year clock. Late planning is still worth doing, but expect damage control, tight documentation, and fewer options. The good news: both paths benefit from the same blueprint, clarity, clean titles, and a proof folder that answers every eligibility question before it's asked. Here's the big picture. Early planning means you start the 5-year clock on purpose. You pick the right tool for your state: a Medicaid Asset Protection Trust, MAPT, a ladybird deed, a transfer on death deed, or a combination. And you fund it properly. You don't plan to plan. You move the asset, retitle the deed, and keep living your life while the clock runs. Meanwhile, you align bank and brokerage beneficiaries so money flows outside probate and doesn't enlarge the estate recovery target. You also maintain tax, insurance, and homestead filings so the home stays clean and defensible. Scrambling late is different. You're inside 5 years or already in crisis. You won't undo past transfers, but you can still reduce exposure. That looks like formal caregiver agreements, real contracts, fair rates, timesheets, smart spend downs on allowable items, and tightening every paper trail. You also pivot from gifts to compliant transactions, market rent, appraisals for sales, and documented reimbursements. The goal is to stop future mistakes and package the file, so a reviewer sees clear value, not guesswork. What works long-term? Timing, documentation, and title alignment. Timing means you start that 5-year clock when you're healthy enough to wait it out. Documentation means receipts, appraisals, contracts, and logs that tell one consistent story. Fair market value, no funny business. Title alignment means the house and accounts actually match your chosen path. If your plan relies on a deed tool to bypass probate, the deed must be recorded correctly. If your plan uses a trust, the house must be deeded into the trust. A trust with an unfunded house is just a binder on a shelf. The thing most people miss is that do nothing costs the most. Penalties stack. Delays burn cash. Estate recovery waits politely and then claims first position in probate. Waiting also invites errors. Blank beneficiary lines, outdated deeds, and undocumented family help that looks like a gift. Meanwhile, monthly care bills don't pause. Every week of indecision is money out the door you'll never recover. If you remember nothing else from this blueprint, remember this. Start the 5-year clock. Now, if you can. Earlier is easier. You'll have more tools, more leverage, and more clean outcomes available. This isn't sneaky, it's seatbelts for your money. You're complying with the rules as written, not trying to outsmart them at the 11th hour. So how do we choose the right shield? Begin with a simple matrix built with local counsel. Column 1, your state's deed options, Lady Bird, TOD, both, or neither, and whether they limit recovery or only avoid probate. Column 2, trust suitability. Does an income-only irrevocable trust, often called a MAPT, fit your goals? And can you live with the rule that you keep income rights but not principal access? Column 3, timing reality. Are you outside 5 years, close to it, or already inside? Column 4, spouse status. Community spouse at home changes the calculus and opens spousal protections you don't want to compromise by moving too fast or in the wrong way. Once you map that, pick your path. If you're early and your state's deed tools don't reliably limit recovery, consider an MAPT and start the 5-year timer. If your state recognizes enhanced life estate deeds that meaningfully avoid probate exposure, a Lady Bird deed could be a fast, lower-friction way to route the home directly to beneficiaries at death in some states. If you're late, combine disciplined damage control with a probate avoidance deed where appropriate, or a narrowly tailored trust. If counsel advises, it still helps. Always pair with correct beneficiary designations, so cash doesn't fall into probate by accident. Next, operationalize it. Inventory, proof folder, titles, beneficiaries, council meeting. Then calendar 2 habits. An annual checkup on titling, taxes, insurance, and beneficiary forms, and a life event alert for moves, marriages, deaths, or care transitions. Those are the moments plans silently break. Once you nail this foundation, everything else clicks. The advanced tools get simpler. And the most powerful one most people never hear about. An income-only irrevocable trust becomes easy to understand and use the right way. Let's break that down next. Income-only irrevocable trusts, MAPTs, made simple. Let's demystify the tool almost nobody explains well. The Medicaid Asset Protection Trust, often called an income-only irrevocable trust. The big idea is simple. You move assets you want to protect, usually the house and certain investments, into a trust you can't dissolve or take principal back from, and you keep the right to any income the trust generates. Because you no longer own the principal, those assets can be treated as non-countable after the look-back passes, while you still live in the home and collect income. Why income only matters. Medicaid looks at control. If you can reach back into principal, it's still yours. In an income-only MAPT, you give up access to principal on purpose. A trustee, someone you trust who isn't you, controls distributions of principal under the trust terms. You retain the right to live in the house, get rental income if you ever rent it, and receive dividends or interest from trust investments. That structure is what moves assets out of the countable bucket after the 5-year clock. Here's the timing truth. Protection isn't instant. The look-back still applies. Assets you place into the trust start their own 60-month timer, 30 months in California's phase-down path. Put the house in today, and 5 years from today, it can be outside the penalty danger zone, assuming the trust was drafted and funded correctly. That's why earlier is easier. The trust isn't a crisis lever. It's a seatbelt you buckle while you're steady. How it works in daily life. Your name comes off the deed, and the trust takes title, but you keep full use and control of the property's lifestyle rights through the trust. Live there, maintain it, pay taxes from your personal funds, and claim applicable exemptions if your state allows under trust ownership. For investments, income flows from the trust to you, tax to you, while principal stays parked for long-term protection. When you pass, the trust distributes to your chosen beneficiaries without probate, typically with estate planning benefits tied to basis rules as your attorney structures them. Pitfalls to avoid. First, trustee choice. Pick a dependable adult child, relative, or professional who understands fiduciary duty and will follow the trust's rules. Don't name yourself. Second, sloppy funding. A beautifully drafted trust that isn't funded is just paper. Deed the house into the trust. Retitle the accounts your attorney approves for trust ownership. Update insurance and property tax records to match the new title. Third, keeping too much control. Retaining principal access in formal side agreements or powers that look like de facto ownership can blow eligibility. Follow the blueprint precisely. Fourth, informal transfers. Don't plan by first gifting the house to a child, then trying to tuck it into a trust later. That creates a gift, triggers tax and look-back issues, and removes the legal structure that keeps control orderly. Expectations. What a MAPT doesn't do, it doesn't let you tap principal personally. If you need principal for you, this isn't the right tool. It doesn't erase the look-back. It starts it. It doesn't fix prior gifts. Those remain part of your timeline. And it doesn't replace the need for a clean proof folder, titles, statements, taxes, insurance, and a trustee who can answer questions with documents, not guesses. Why this structure helps with estate recovery. In many states, assets properly titled in an irrevocable trust and held there through death avoid probate and can be outside the estate recovery path. That's not universal. State rules vary, so you pair the trust with state-specific drafting and, where relevant, deed strategies that complement it. The benefit is layered. Long-term Medicaid positioning, probate avoidance, and a clearer line of succession for the home and protected assets. Practical example to lock it in. You're 72, healthy, homeowner, modest investments, and you want the house safe for your spouse and kids. You create an income-only irrevocable trust with local counsel. You deed the home into the trust and move a conservative bond fund your attorney approves. You keep living at home, paying taxes and insurance. Interest and dividends still hit your bank account. 5 years pass. If long-term care is needed later, the home's principal sits outside the countable pile. Your proof folder shows clean titling and maintenance and your beneficiaries are pre-positioned for a smoother transition. Common questions. Can you sell the house after funding the trust? Yes, the trustee can sell, and the trust can buy a replacement residence titled to the trust, handled cleanly with your attorney's guidance, so protection continues. Can you change trustees? Good drafting usually allows removing and replacing a trustee without granting you powers that undermine eligibility. Can you amend terms? Limited powers may exist for non-financial provisions or through a trust protector, but avoid changes that hand control back to you. Implementation checklist. Meet elder law counsel for state-specific design. Draft the income-only irrevocable trust. Choose and confirm the trustee. Deed the home into the trust. Record properly. Retitle approved accounts. Update insurance, taxes, and homestead filings as your state allows. Build your proof folder with the deed, trust, funding confirmations, and annual statements. Calendar annual checkups to confirm everything stays aligned. Remember the headline: a MAPT isn't a stunt. It's a discipline tool that trades principal access today for protection tomorrow. If you can live with that trade, start the clock while you're calm, keep documents tight, and let time do the heavy lifting. If you can't wait 5 years, don't worry. There are still moves we can make inside the window, and we'll cover those soon. Ladybird deeds and TOD deeds, fast probate bypass. Let's talk about the fast lane tools everyone hears about, but few use correctly: enhanced life estate deeds, often called ladybird deeds, and transfer on death, TOD deeds. The point of both is simple: keep the house out of probate, so it passes directly to your chosen beneficiaries at death. Why that matters here? Estate recovery usually targets the probate estate. If the home doesn't enter probate, in some states that sharply reduces or avoids recovery exposure. In others, it only speeds transfer. That state difference is the whole game. First, what these deeds actually do. With a ladybird deed, you keep a super life estate. You stay in control during life. Live there, sell, refinance, even change beneficiaries without the remainder person's consent. At death, the property passes automatically to the named beneficiaries with a TOD deed. You also keep full ownership and control while alive. Then the deed springs to your beneficiary at death. No probate. Both avoid lifetime gifts and usually avoid immediate tax issues tied to gifting the house. Both keep day-to-day control where you want it, with you. Probate avoidance is the practical win. If your state limits recovery to probate assets, these deeds can be powerful. The home passes outside probate, so there's nothing for the estate to distribute. In states with expanded estate definitions or specific recovery statutes that reach non-probate transfers, these deeds may not stop recovery, but they still avoid court delays and simplify transfer. Translation: sometimes they protect, sometimes they just speed things up. That's why you ask a local elder law attorney, do these deeds reduce recovery risk here? Or just bypass probate? Limits you need to respect. Availability is state-specific. Ladybird deeds are only recognized in certain states. TOD deeds exist in many, but not all, and each has exact statutory language and signing rules. Neither deed fixes the look back. Recording one inside 5 years doesn't erase prior gifts or deed mistakes. And neither deed, by itself, protects against equity limit problems during life. They are transfer tools, not blanket shields, where they fit cleanly. If you're early in planning, healthy, and your state's recovery rules favor probate-only claims, a ladybird or TOD deed can be a low-friction way to route the home directly to family at death, often preserving a step up in basis and avoiding probate costs. If you're inside 5 years and can't fund a trust without triggering penalties, a properly drafted deed can still position the house outside of probate and align with a late-stage strategy, especially if a spouse or disabled child creates deferral protections. In many plans, we pair deeds with beneficiary updates on accounts, so the estate stays small. When to use deeds alone versus pairing with a trust. Use a deed alone if your goals are straightforward. Keep living in the house, pass it to the kids, and your state's rules make probate avoidance enough to limit recovery. Pair with an irrevocable trust, MAPT, if you want long-term asset protection beyond probate avoidance and can start the 5-year clock. Pair with a revocable trust if you're aiming for global probate avoidance, coordinated distribution, and simplicity. But remember, a standard revocable trust by itself may not stop recovery in some states. The house still needs to be titled correctly to match the plan. Your quick attorney checklist before you touch the deed. 1. Confirm whether Lady Bird or TOD deeds exist in your state and which actually limit recovery versus simply avoid probate. 2. Verify homestead, tax, and creditor rules under deeded ownership. 3. Get the exact titling and beneficiary language, names, alternates, and how to handle a predeceased beneficiary. 4. Coordinate with your broader plan. If you might use a MAPT, decide the order. Trust first, then deed from trust if appropriate. 5. Record it right. Drafting is step 1. Recording is what makes it real. Keep a certified copy in your proof folder. Common mistakes to avoid. Don't add children to the deed as co-owners to make it easy. That's a present-day gift with look-back problems and potential tax headaches. Don't rely on generic forms or mismatched state templates. Don't forget insurance and property tax records. Update them after recording so mail and coverage stay clean. Don't name the estate as beneficiary. That drags the house back into probate. And don't assume a deed cures a sloppy estate plan. Align beneficiaries on accounts so cash doesn't spill into probate and enlarge recovery exposure. If you remember nothing else about these deeds, remember this. They're speed tools that sometimes double as shields depending on your state. Use them precisely with the right language, recorded on time, and matched to your larger plan. When they fit, they deliver a clean, court-free handoff, and in the right states, a stronger defense against post-death recovery. When they don't, they still tighten your plan and cut the chaos your family faces later. Use the right tool for your state and write it exactly right. Stop doing these 7 helpful things that trigger penalties. Let's cut the 7 moves that feel helpful but blow up eligibility fast. If you stop these, everything else gets easier. 1. Adding adult kids to the deed for convenience. On paper, that's gifting a chunk of your home's equity for less than fair market value. In the look back, it's a transfer that triggers a penalty. It also drags your house into their life risks, divorce creditors, lawsuits. If the goal is easy transfer, use a state-approved deed tool or a trust with counsel. Don't hand away equity today to solve a tomorrow problem. 2. Big gifts inside 5 years. It's for the grandkids. Still counts. Tuition checks, wedding gifts, generous Venmo transfers. If you didn't get equal value back, Medicaid treats it as a gift. The penalty math doesn't care about intentions. If you want to support family, either do it more than 5 years before care or convert support into compliant arrangements now. Fair market rent, formal caregiver pay, or documented reimbursements with receipts. 3. Selling the house to family for $1 or any undermarket sale. Medicaid compares the sale price to fair value. The gap is a transfer. A $1 deed is a giant gift. If you need to sell, get a current appraisal, list, and document the sale at market, and keep the entire paper trail, contract, closing statement, deposits. If family wants to buy, great, at a real price with real financing. 4. Paying family caregivers under the table. No contract, no timesheets, no mercy. Unpapered, help looks like gifting. If a child provides care, write a caregiver agreement at a reasonable hourly rate, start timesheets, and pay by check. Log tasks. Keep mileage if they drive you. This turns a penalty magnet into a legitimate expense that supports eligibility and can even reduce spend-down stress. 5. Moving assets and calling it a loan with no note or schedule. If there's no signed promissory note, market interest, and actual repayments, Medicaid treats it as a gift. If you truly loaned money, fix it. Draft a note with reasonable interest, set a payment plan, and start making documented payments back to you. If those dollars are gone, assume exposure and plan for a penalty period instead of getting blindsided. 6. DIY forms that wreck eligibility. Internet trusts, generic deeds, and beneficiary designations copied from a neighbor often have the wrong language, the wrong state statutes, or never get recorded. The result? Assets fall into probate, recovery applies, or look-back penalties trigger because a fix was actually a transfer. Local elder law counsel is cheaper than months of private pay bills and a denied application. Use the right form, in the right state, filed the right way. 7. Waiting until discharge to nursing home to start. 0 runway, maximum penalty. At crisis, you'll have no proof folder, unknown transfers, missing statements, and a facility asking who's paying this month. Even if you're inside 5 years, there's damage control. Convert gifts to contracts, complete spend downs on allowable items, clean titles, and package the file. But don't choose the hardest version of this. Start now and cut months of uncovered cost. Now, the fix is so you can pivot today. For deeds, stop adding co-owners. If your state allows it, consider a ladybird or TOD deed drafted and recorded by counsel, or a MAPT if timing fits. For gifts, freeze new ones and inventory the past 5 years. Convert active help into compliant agreements. For sales, order an appraisal, and keep closing documents in the proof folder. For caregiver pay, sign the contract this week, set a fair rate, and log hours going forward. For loans, either formalize with a real note and payments or accept penalty math and plan for a lawful bridge. For DIY paperwork, pause and book an elder law consult to audit titling and beneficiaries. For timing, assemble 5 years of statements now, pull deeds and insurance, and schedule the application roadmap, even if care isn't imminent. 2 quick micro stories. A son was helping mom by moving $1,000 monthly to his account for groceries. No receipts. We drafted a caregiver agreement at fair rates, switched to checks, kept logs, and documented actual expenses going forward. Past transfers still counted, but we cut future penalties to 0 and supported a shorter ineligibility period. Another family sold dad's truck to a nephew for half value. We pulled comps, showed repairs needed, and documented the true condition with photos and mechanic invoices. The state accepted a reduced fair value, trimming a potential 2-month penalty to a few weeks. Common pushbacks. But the bank told me to add my daughter. Banks simplify access. Medicaid reads equity. Solve access with powers of attorney, not ownership gifts. We already did small gifts. Map them, compute exposure, and focus on airtight documentation from today forward. We'll fix it when we need care. Facilities bill monthly. The state reads 5 years. Waiting trades options for invoices. If you remember nothing else, remember this line. Good intentions don't beat the look back, documentation, and fair value do. Stop gifting equity by accident. Stop paying without paper. Stop timing your plan to a crisis, and your eligibility journey gets 10x smoother. Now, if you're already inside 5 years, don't panic. There's smart damage control that actually helps. That's next. Inside the 5 years, damage control that actually helps. If you're already inside the 5-year window, don't freeze. You can't erase history, but you can tighten today, document tomorrow, and aim the application so it lands cleaner. Think 2 goals. Reduce countable assets the right way and convert gift-looking patterns into legitimate, papered expenses that support care. Start with smart spend downs. You're allowed to spend your own money on your own needs at fair market value. That means improving safety and function, not dumping assets. Prioritize home safety upgrades. Grab bars, ramps, wider doorways, better lighting, non-slip flooring, and a sturdy shower setup. Medical needs count, too. Hearing aids, dentures, glasses, mobility devices, and therapy equipment prescribed by your clinician. Catch up on dental and vision. Prepay permitted items. Burial/cremation through irrevocable funeral arrangements in states that allow it, cemetery plots, and modest memorial costs. Refresh essentials. Properly sized clothing, safe shoes, a lift chair if needed. Keep every invoice and receipt in the proof folder. Next, get caregiving out of the shadows. If a family member helps, make it real. Draft a caregiver agreement with counsel or a reputable template adapted for your state. Include start date, duties, hours, an hourly rate at local market levels, and how you'll pay. Begin timesheets today. Don't backfill. Pay by check or bank transfer with memo lines. Keep mileage logs for appointments and shopping. The difference between a gift to my daughter and payment for care at a fair rate is paper, timing, and consistency. If a family member provides housing or you live with them, use a personal care or rent agreement. Set a reasonable monthly amount that covers room, board, and care tasks if appropriate. Spell out what's included. Collect deposits and monthly payments via bank, not cash. Again, keep logs. States see informal arrangements all the time. You're showing a clean, market-based transaction. For assets you still hold, consider partial options. Some states allow compliant annuities or spousal strategies that convert countable resources into income for the community spouse. Others have state-specific tools that can soften a penalty or shorten exposure. This is where local counsel pays for itself. Don't sign annuities or promissory notes without state-savvy guidance. The wrong terms can be treated as transfers. Handle loans and transfers. If you previously loaned money to a relative with no note, you likely have a gift. If the relative can repay, draft a promissory note now with a reasonable interest rate and a real payment schedule, then begin payments. Each payment back to you becomes an available resource you can spend down properly. If repayment isn't possible, calculate the likely penalty and build a bridge for those months so facility bills are covered during ineligibility. Clean up cash surprises. Cash withdrawals with no receipts are red flags. Starting today, stop cash. Use checks and cards for traceability. For recurring costs, groceries, pharmacy, transport, keep itemized receipts. If a relative buys things on their card, reimburse with a check tied to the receipt and place both in the proof folder. Daily discipline now prevents weeks of questions later. Your crisis mindset matters. Document everything. Don't panic and don't hide transactions. The reviewer's job is to connect amounts to real needs. At real prices, you're making that easy. Build a simple one-page monthly ledger. Date, payee, purpose, amount, proof, file name. When the state asks, you hand them a tidy map, not a shoebox. 2 quick micro stories. A daughter was receiving $1,200 monthly for groceries. We replaced it with a caregiver contract at $22 per hour for documented tasks, capped hours to market levels, added timesheets, and paid through a separate account. Past months were exposed, but future months became clean spend down. Another family paid a nephew cash for ramps and grab bars. We redid it, new written estimate, check payment, photos before/after, and a contractor invoice, even though the nephew did the work. The paper turned a fuzzy expense into an accepted safety upgrade. Common mistakes inside 5 years. Don't gift away small amounts thinking they won't notice. Small stacks add up. Don't buy luxury items you won't actually use. They look like asset shifts. Don't prepay rent years in advance. Many states will treat the excess as a transfer. Don't sell a car or equipment to family for a token amount. Use book values, photos, and a bill of sale. Don't delay the application waiting for perfect. package what you have, fix what you can this month, and let counsel sequence the filing. Here's your 30-day triage. Week 1. Freeze gifting, switch to traceable payments, and inventory the last 60 months with a highlighter. Week 2. Install caregiver or rent agreements, set fair rates, start logs, and move recurring bills to check/ACH. Week 3. Execute safety and medical spend-down items with invoices, and prepay burial if allowed. Week 4. Meet counsel to test state-specific tools, compute any penalty, and plan coverage for the ineligibility window. Then keep the pattern, document, don't guess, and keep everything in the proof folder. If you remember nothing else, remember this. Inside 5 years, you win with clean spend-downs, real contracts, and relentless documentation. Turn gifts into services at fair value, turn cash into receipts, and turn panic into a ledger. That's how you turn a penalty magnet into an approvable file. The house, exemptions, equity limits, and when it's safe. Let's get crystal clear on the house, because this is where confusion turns expensive. During life, your primary residence can be exempt from Medicaid long-term care if you meet the rules. Exempt doesn't mean invisible. It means not counted for eligibility while certain conditions hold. After death, recovery rules still apply, which we covered earlier. So the play is knowing when it's exempt now, how equity limits work, and how to keep it aligned with your plan. While you live there, most states treat your home as exempt up to an equity cap. That cap is state-specific, usually a 6-figure number that updates periodically. If your equity exceeds the cap and you're single, you can trip eligibility problems unless you adjust. If you're married and a community spouse stays in the home, different protections apply. The simple test most caseworkers use: is this your primary home? And do you intend to return if you're temporarily out for rehab or care? Intent to return matters, even if it's unlikely you state it, and the home can remain exempt during life under many state rules. Short absences don't change that. Hospital stays, rehab, or a trial period in assisted living don't automatically flip your home to countable. Keep your documentation clean. Driver's license, voter registration, mail, and utility bills tied to the home. If you're gone longer but still intend to return, keep taxes and insurance current, and note that intent in your application file. A silent file looks abandoned. A documented file looks like a home. Community spouse basics are powerful. If a spouse remains in the home, the residence is generally exempt regardless of equity, and the spouse can keep it. That doesn't erase future estate recovery, but it protects housing now. Don't jeopardize that with sloppy transfers. Keep title consistent with your plan, and avoid adding adult children as co-owners to help. Use powers of attorney for access, not ownership gifts that create look-back trouble. Equity limits are where folks get surprised. If you're single and your equity is above your state's cap, you've got options. You can invest in medically necessary home safety upgrades at fair market value, which reduces equity only if financed or through legitimate liens, not gifts to kids. You can consider a compliant reverse mortgage line of credit if it fits your scenario and state rules, coordinated with counsel, so proceeds don't become countable cash sitting in your account. Or you can sell and purchase a lower equity primary residence, documented start to finish at market value. The point is to align with the cap without triggering transfers for less than fair value. Title must match your plan. If you're using a trust, the deed needs to be titled to the trust properly. If you're using a Lady Bird or transfer on death deed in a state where it helps, record it correctly with the right remainder beneficiaries and alternates. If you intend to lean on community spouse protections, keep ownership clean and avoid changes that could accidentally push the home into probate or expand recovery exposure later. A plan that lives only in your head won't help. The county recorder needs to see it. Paper trail is your quiet superpower. Keep property tax bills, paid receipts, insurance declarations, homestead filings where applicable, and proof of maintenance. If you rent a room or consider housemates to cover costs, use a market lease and separate deposits, not cash. If a child lives there and helps, use a personal care or rent agreement at a reasonable rate, not free room, for help that later looks like an unpapered transfer of value. When is the house safe? It's safest when 4 things line up. 1. It's your primary residence with intent to return documented, or your spouse lives there. 2. Equity sits under your state's cap if you're single, or you've adjusted prudently. 3. Title is aligned to your chosen strategy, trust or deed, recorded and maintained. For the proof folder is tight. Taxes, insurance, homestead, utilities, any leases, and repair invoices in one place. That's how caseworkers check boxes fast and reviewers stop asking follow-ups. Now, a few speed bumps. Don't prepay years of property expenses to spend down. Many states treat excess prepayments as transfers. Don't deed partial interests to kids to lock it down. That's a gift and often creates capital gains headaches later. Don't let insurance lapse. Uncovered damage plus an application is a double headache. And don't forget beneficiary alignment on non-home assets. If those spill into probate, recovery grows even if the house is handled well. Last point, if you sell while the home is exempt, the sale proceeds become countable cash unless immediately and properly routed. New primary residence purchase, allowable spend downs with documentation, or trust strategies per counsel. Coordinate closings, deposits, and purchases so money doesn't sit in your account blowing eligibility. If you remember nothing else, remember this. Declare your intent, confirm equity fits your state's cap, match title to your plan, and keep the proof folder spotless. Do that, and your home stays livable during life, positioned for a cleaner transition, and far less likely to be the surprise funding source for past care. Community spouse protections without the headache. If one spouse needs long-term care, the goal is simple: get care without bankrupting the spouse at home. Medicaid actually has rules for this, but you have to use them correctly. Think of 2 buckets: assets you're allowed to keep and income you're allowed to keep. Get those right, and the spouse at home stays stable. Start with the Community Spouse Resource Allowance, or CSRA. States set a minimum and maximum amount of countable assets the community spouse can keep. The applicant spouse usually gets a very low asset limit. The spouse at home keeps the CSRA plus certain excluded assets, like the primary residence under community spouse rules. The caseworker looks at your combined countable assets on the snapshot date, often the date of admission to a facility or when continuous institutionalization begins, then allocates up to the CSRA to the spouse at home. Translation: we organize assets so the non-applicant spouse legally holds the protected share. Now, income. Medicaid care is income tested for the applicant, not the community spouse. That means the spouse at home can generally keep their own income. If their income is low, many states allow a diversion from the institutionalized spouse's income to the community spouse via a minimum monthly maintenance needs allowance, MMNA. It's a floor designed to prevent poverty. If housing and utility costs are high, you may qualify for an excess shelter allowance that bumps the MMNA higher. The reason this matters: shifting a lawful slice of the applicant's income to the spouse at home reduces what's paid to the facility and keeps the lights on. Before we continue, you need to understand spousal refusal. In some states, a community spouse can refuse to contribute assets to the applicant's care. The state may still approve Medicaid for the applicant and then pursue contribution from the refusing spouse. It's a technical lever, not a first choice. You only consider it with local counsel who knows your state's policy and risks. Don't copy a neighbor's story here. Here's where most people mess up, rushing to split accounts or move assets blindly. Timing and paper trails matter. The state wants to see how assets sat on the snapshot date, how they were allocated to the CSRA, and how spend downs happened at fair market value. If you shuffle funds with no statements, or you gift to kids in the process, you create look-back trouble and slow eligibility. Keep transfers between spouses clean, traceable, and consistent with the allocation. What does a clean path look like? First, identify the snapshot date with counsel. Second, list every account with balances as of that date. Third, map the CSRA, which accounts move to the community spouse and which remain with or are spent down for the applicant. Fourth, execute spend downs on allowable items, home safety, medical needs, prepaid burial where permitted, paid from the right spouse at market value, with receipts. Fifth, if income shifting is needed, document shelter costs to support the maximum MMMNA. A quick example, you have $220,000 in countable assets on the snapshot date. Your state's CSRA maximum covers $154,000. We allocate $154,000 to the community spouse and spend down the remainder on approved items, keeping a receipt trail. The spouse at home keeps their Social Security and pension. Their income falls below the MMMNA, so we divert part of the applicant's income, documented with a shelter worksheet. The applicant's patient pay amount drops, Medicaid fills the gap, and the spouse at home keeps the budget intact. Common mistakes to avoid: paying off an adult child's car or credit card as spend down. That's a gift. Transferring the house to kids for safety. That's a gift and wrecks the plan. Draining retirement accounts without tax planning. Big tax hits shrink what the spouse can keep. And splitting accounts without printing statements. No paper, no proof. Your clean checklist, statements for all accounts on the snapshot date, income proof for both spouses, mortgage, tax, insurance, and utility bills to support MMMNA, valuations for vehicles and personal property if relevant, caregiver or rent agreements if the spouse at home provides or pays for support, and counsel's written allocation plan. Bring that packet to the application meeting. It cuts weeks of back and forth. If you remember nothing else, remember this. The community spouse path is about structure, not sacrifice. Use the CSRA to protect assets. Use MMMNA rules to stabilize income, avoid gifts, and document every move. Once you nail that, you can tie it together with powers of attorney, beneficiary updates, and a proof folder that stops surprise bills before they start. Paper shield, beneficiaries, POAs, and the proof folder. Here's the paper shield that makes everything you've built actually work. Think 3 layers: the right powers, the right beneficiaries, and one proof folder that answers questions before the state asks them. Start with powers of attorney. You need a durable financial power of attorney that explicitly includes Medicaid planning powers under your state's law. That means authority for gifting within limits, creating and funding trusts, changing beneficiary designations where allowed, handling real estate, and accessing digital/online financial records. A generic POA can stall when you need it most. The healthcare proxy, or medical power of attorney, and HIPAA release let your agent speak with doctors, retrieve records, and sign care contracts without gaps. If you already have these, check dates and state compliance. Refresh if they're old or missing Medicaid language. Next, beneficiary designations. These decide whether money sidesteps probate or falls into the recovery bucket. Review every account: bank, CDs, brokerage, life insurance, annuities, retirement accounts. Add payable on death POD or transfer on death TOD where appropriate and permitted by your plan. Coordinate with your trust or deed strategy so the flow is consistent. Avoid estate as a beneficiary that drags assets back into probate. If you're using a MAPT, your attorney will guide which assets name the trust, which stay individual, and how to structure alternates. Update forms in ink, get confirmations, and store copies in the folder. Now, the proof folder. Paper wins this game. Make a simple structure you can hand to a reviewer or your POA, and they can run it without drama. Section 1, Identity and Powers. photo ID, Medicare/insurance cards, Social Security letter, durable POA, healthcare proxy, HIPAA, living will if you have one. Section 2, house and real estate, latest deed, trust, Lady Bird, or TOD deed, property tax bills and paid receipts, homeowners insurance declarations, homestead filings if your state uses them, HOA statements, and any lease/rent agreements with logs, if applicable. Include appraisals or comps if you've sold or plan to sell, plus closing statements. Section 3, financials. Last 60 months of bank and brokerage statements, retirement account statements, life insurance details, cash value versus term, annuity contracts, and a list of current account numbers and online access instructions. Flag any transfers with a sticky note and attach proof, bills of sale, appraisals, caregiver contracts, or loan notes with payment records. Section 4, income and bills. Social Security and pension letters, pay stubs if working, rent receipts if you receive rent, and monthly fixed bills, mortgage, taxes, utilities, insurance, medical premiums. If you'll request an MMMNA, include the shelter cost worksheet and copies of those bills. Section 5, care documentation. Caregiver agreements, timesheets, mileage logs, invoices for home safety upgrades with before/after photos, prescriptions for equipment, therapy plans, and receipts for medical, dental, and vision spend downs. Section 6, coverage and notices. Medicare Advantage or Medigap ID cards, Part D plan details, creditable coverage notices from any employer/retiree plans, COBRA letters if applicable, and any Medicaid correspondence. Keep copies of any hardship waiver instructions your state publishes. Section 7, trusts and estate planning. Full trust document, MAPT or revocable, trustee acceptance, funding confirmations, trust bank/brokerage statements, and any trust tax statements. If your trust has a protector provision or amendment powers, add that page tabbed. Label the folder spine and mirror it in a cloud drive. Medicaid proof, year. Scan every item. Name files with dates first. 202411015_property tax paid. .pdf. Your agent can share a tidy link instead of mailing piles of paper. Annual checkups keep this alive. Once a year, do 4 quick things. 1. Confirm titling. Pull the deed, peek at account owner fields, and verify POD/TOD beneficiaries still match the plan. 2. Verify taxes and insurance are current and saved. 3. Recollect creditable coverage letters and any plan change notices. Run a 5-minute transfer audit, any gifts, cash pulls, or odd payments. If yes, attach documentation now, not later. 2 micro stories. A family submitted a perfect application because their proof folder mapped every $300 transfer with receipts. Approval landed weeks faster. Another had a strong trust, but never retitled the house. Probate pulled it back, and recovery attached. 1 recorded deed would have avoided months of cleanup. Common mistakes. Blank beneficiary lines that default to the estate. Old POAs missing Medicaid powers. Caregiver help with no contract or logs. Deeds drafted but never recorded. And folders that live only in someone's head. Quick start this week. Print your current POA and ask counsel, does this include Medicaid powers? Add POD/TOD to one small account and save the confirmation. Create the folder shell with 7 sections and drop in what you already have. Label it. Future you will send you a thank you card, your 30-day protection plan. Let's turn all of this into action. 30 days for simple weeks, 1 clean result. The clock starts, the house and accounts line up, and your proof folder is ready for scrutiny. Week 1 is inventory and visibility. Pull a clean list of everything you own and how it's titled. Home, land, bank accounts, CDs, brokerage, retirement, life insurance, annuities. Print the latest statements. Grab your deed, property tax bill, and homeowner's insurance. Note any POD/TOD or beneficiary designations on each account. If a line is blank or says estate, circle it. Find your powers of attorney and healthcare proxy. If they're older or missing Medicaid powers, flag them. Start the proof folder, 7 sections labeled and ready. Drop in identity docs, the deed, tax bill, insurance declarations, and the last 12 months of bank statements while you request the full 60 months. If you're inside 5 years, highlight unusual withdrawals to tag later. Write a draft look-back timeline with dates, amounts, recipients, and any proof you already have. Week 2 is decisions and counsel. Book an elder law consult. Bring your inventory, flagged beneficiary forms, the deed, and your draft timeline. Ask 3 questions. In our state, do Lady Bird or TOD deeds reduce recovery or just avoid probate? Does a MAPT fit my goals? And what must be funded now versus later? What's our timing, outside 5 years, close, or already inside? Decide your path, deed strategy, trust strategy, or both. If a MAPT fits and you're early, start drafting. If you're late, shift to damage control, caregiver agreement, rent agreement if you live with family, and spend down priorities. Meanwhile, fix easy wins. Add POD/TOD to small accounts, update life insurance beneficiaries, and confirm alternates. Week 3 is paperwork and funding. Sign the updated durable POA with explicit Medicaid powers and the healthcare proxy. If you chose a MAPT, sign it and fund it properly. Deed the house into the trust and retitle approved accounts under counsel's guidance. If you're using a Lady Bird or TOD deed, get it drafted with correct remainder beneficiaries and record it. Update homeowners insurance to match title. If a family member provides care, execute the caregiver agreement at a fair market rate, start timesheets, and move payments to checks or ACH with memo lines. If you rent from or to family, sign a market lease and collect deposits properly. Order appraisals or gather comps for any property you plan to sell. Keep the closing checklist ready. Week 4 is alignment and proof. Build out the proof folder fully. Identity and powers, real estate, financials with the oldest statements arriving, income and bills, care documentation, coverage notices, and trust or deed documents with recording confirmations. Scan everything and mirror it in a cloud drive with date-first file names. Complete smart spend downs, safety upgrades, prescribed medical items, dental/vision, and an irrevocable funeral arrangement if your state allows. Keep invoices, receipts, photos, and before/after notes. Freeze new gifts. Switch all recurring expenses to traceable payments. If your look-back timeline shows likely exposure, ask counsel to compute the penalty months and plan a lawful bridge for that window so care bills are covered. If you're inside 5 years, here's your off-ramp now. Formalize family help immediately stop cash withdrawals and replace gift-looking patterns with clean, market-based payments. Don't backfill logs. Start today and be consistent. If a prior loan existed, draft a real promissory note and begin repayments. If repayment isn't possible, accept penalty math and prep coverage for that period. Document, don't guess. A tidy ledger beats a long explanation. 2 weekly habits lock this in. First, a 15-minute Friday file drop. Scan fresh statements, add timesheets, and name files correctly. Second, a Sunday 5-question check. Did I move any money? Do I have a receipt? Is there a contract or invoice? Does title match my plan? Did I add a note to the timeline? Catching small misses now saves months later. Your attorney call script is short and specific. We need a state-correct deed, or MAPT, Medicaid powers in the POA, a beneficiary audit, and a 5-year plan to position the home and accounts. Please confirm whether our state recovers only probate assets or also non-probate transfers. Bring 1 page per asset with owner name, titling beneficiaries, and the action you want taken. By day 30, you should have 3 wins. The 5-year or shorter state clock is running on the tool you picked. Your proof folder exists, digital and paper, with enough statements and receipts to answer most questions fast. And your money is wearing seatbelts, titles, beneficiaries, contracts, and invoices that show fair value and clean intent. Keep momentum simple. Set 2 annual reminders: an October checkup for titling, beneficiaries, taxes, insurance, and plan changes, and a life event alert for moves, marriages, deaths, and care transitions. Those are the moments plans break silently. If you remember nothing else about these 30 days, remember this: inventory, decide, fund, prove. Start the clock, match title to your plan, turn help into paper, and build the folder that wins reviews. That's how families keep the house and their sanity. The 10-minute annual checkup. You've built the plan. Now you keep it tight with a 10-minute annual checkup that prevents small cracks from becoming expensive problems. Think of it as 4 quick reminders, a watch list, a simple family script, and a trigger list for when to call your attorney back. Start with the 4 reminders. 1. Titling. Pull your deed and 1 statement per account. Confirm the house title still matches your plan. Trust, Lady Bird, or TOD, and that pod/TOD or trust beneficiaries are on every non-retirement account. If you see estate or a blank, fix it. 2. Taxes and insurance. Verify property taxes are paid. Homestead, if applicable, is filed, and homeowner's insurance matches current title. Print the declarations page and file it. 3. Beneficiary review. Check retirement, life insurance, and annuities for correct primary and contingent beneficiaries. Align with your spouse and trust strategy. 4. Receipts log. Open your proof folder and add the year's caregiver timesheets, safety upgrades, medical invoices, and any rent agreements. Name files with dates first so you can hand a clean story to a caseworker in 5 minutes. Now the watch list. State rule changes happen quietly. Each fall, scan your state Medicaid site or ask counsel about updated home equity limits, look-back interpretations, and estate recovery scope, probate only versus expanded estate. Watch for letters from your insurer, bank, or county recorder that hint at title or policy changes. And stay alert for any Medicaid estate recovery notices. Act fast and hand them to counsel with your proof folder index attached. Run a quick family meeting once a year. Keep it short, calm, and clear. Say, here's where the deed, trust, POAs, and proof folder live. Here's who to call. If I'm hospitalized, use the healthcare proxy. If I move to rehab, keep the house bills current and log every caregiving hour. Assign roles. 1 person handles paperwork, 1 handles bills, 1 is backup. No debates, just responsibilities. Finish by confirming every adult has copies of the POAs and knows the folder location. When do you call your attorney back? Use this trigger checklist. You moved, sold, or refied the house. A spouse, trustee, or primary beneficiary died or became disabled. You married, divorced, or blended households. A child caregiver started or stopped. You're considering selling to family, renting to family, or buying a replacement home. You're within 5 years of a major gift, or you've discovered an old, unpapered transfer. Your state announced changes to estate recovery or deed statutes, or you're approaching a care transition, assisted living, memory care, or skilled nursing. Any one of these triggers a review to retitle, amend beneficiaries, and update the proof folder before surprises multiply. 2 quick micro stories. A viewer's insurer auto-retitled the policy after a system update, dropping the trust name. A wind claim later stalled coverage. Their 10-minute check found it in time to fix. Another viewer moved across county lines and forgot to refile homestead. Taxes jumped, cash ran low, and eligibility got harder. A 1-page homestead confirmation in the checkup would have prevented it. Common mistakes this checkup catches. A recorded deed never made it to the insurer. A bank merged and wiped pods. A new retirement account defaulted to estate. Caregiver pay crept above local rates without documentation. A burial plan wasn't irrevocable under current state rules. 10 minutes now beats months of cleanup later. If you want an even lighter version, here's the 2-minute mini. Pull one bank statement and the deed. Confirm names and beneficiaries. Snap photos of the insurance declarations and tax bill. Drop them into your proof folder with the current year tag. Then set a calendar reminder. Medicaid checkup, same day next year. Label the habit this way: audit, align, file, and flag. Audit titles and beneficiaries. Align taxes, insurance, and homestead. File receipts and agreements. Flag triggers that need counsel. If you remember nothing else, remember this: a tiny checkup once a year keeps your 5-year plan intact, your house aligned, and your family out of crisis mode. Rapid fire myth busting. Medicaid is only for the poor. Not true. Long-term care costs crush middle-class families fast. Medicaid has strict rules, yes, but it also has built-in paths like spousal protections, exempt homes during life, and allowed spend-downs. Planning early uses those rules legally. Waiting turns simple steps into penalties. I'll lose control if I use a trust. With an income-only irrevocable trust, you give up access to principal on purpose, but you keep important rights. You can live in the house, receive income the trust investments generate, and name a trustee you trust. Control over principal is what Medicaid looks at. Take your hands off principal, keep the income, and you get long-term positioning without chaos in daily life. I can't. Start now, it's too late. Inside 5 years, you still have moves. Convert fuzzy gifts into caregiver contracts. Do fair value safety upgrades. Prepay allowable burial. Clean titles and build a proof folder. You can't erase history, but you can stop creating penalties and package a review-ready file that moves faster and costs less. My state doesn't do recovery. Estate recovery is federal policy implemented by states, and rules vary. Most states pursue recovery against probate estates. Some reach further. That's why state-specific counsel matters. Deeds and trusts aren't magic, they're state tools. Ask, does my state limit recovery to probate assets or reach non-probate transfers? Lady Bird and TOD deeds fix everything. They avoid probate. In some states, that also limits recovery. In others, it only speeds transfer. They don't erase look-back penalties, and they don't fix equity cap issues during life. Use them to route the home cleanly. Pair them with beneficiaries on accounts so cash doesn't fall into probate, and enlarge the target. Small gifts don't count. Gifts are transfers for less than fair value. Lots of small adds up. Tuition, Venmo, holiday envelopes. If you didn't get equal value back, they're countable in the look back. Freeze gifting now. Convert support to market-based payments with receipts and document everything going forward. Add a child to the deed to make it easy. That's a current gift of equity with look-back risk and potential tax problems later. You also expose the home to the child's creditors or divorce. If convenience is the goal, use a deed tool or trust drafted for your state. If access is the goal, use powers of attorney. Medicaid sees any trust as off limits. Medicaid looks at control and access. Revocable trusts are generally countable because you control them. Income-only irrevocable trusts are designed specifically to limit principal access while preserving income rights. Structure and funding are everything. Caregiver pay to family is always a problem. It's a problem if it's informal. With a contract, fair market rates, timesheets, and bank payments, it's legitimate. You turn a gift-looking pattern into a loud spend down that supports care and eligibility. I'll just sell the house to family for $1. Medicaid compares sale price to fair market value. The difference is a transfer. Get an appraisal, sell at market, keep the full closing trail. If family buys, fine, at a real price with real paperwork. My neighbor did X, so we'll do X. Rules change by state, by timeline, and by facts. Your neighbor's good result with a ladybird deed or a trust doesn't mean it fits you. Spend 1 hour with local counsel, and you'll avoid a year of cleanup. If you remember nothing else, remember this. Fair value correct titles and documentation beat myths every time. Early planning buys options. Late planning still works when it's papered right. FAQs you'll ask next. Can I sell my house after I fund a trust? Yes, if it's an income-only irrevocable trust, the trustee sells and the trust receives the proceeds. You can also buy a replacement residence inside the trust, so protection continues. Get counsel to coordinate the sale, purchase, deposits, and title so no proceeds detour into your personal account. What happens if I move states? Medicaid is state-run. The look-back history follows you, but eligibility, equity caps, deed options, and recovery rules change. When you move, meet local counsel to retitle the home if needed, update deeds or trusts to the new state standards, and confirm homestead, taxes, and insurance match the new title. Rebuild your proof folder with new local documents. Can I change trustees later? Usually yes, if your trust is drafted with removal and replacement language or a trust protector. You're not handing your life to one person forever. You can replace a trustee who can't serve while keeping your own hands off principal so eligibility isn't jeopardized. What if I need money from a trust? With an income-only irrevocable trust, you receive income, not principal. If you'll need principal for personal use, that's a sign the MAPT might not be a fit, or that you should keep a separate emergency pool outside the trust. Ask counsel to design liquidity on the non-trust side, so your plan is sustainable. How do I pick a good elder law attorney? Look for Medicaid-specific experience, not just estate planning. Ask, how many Medicaid applications did you complete last year? Do you draft MAPTs and Lady Bird/TOD deeds in this state? Will you map look-back exposure and build an application packet? Fee clarity matters. Flat fees for defined work reduce surprises. Will a Lady Bird or TOD deed affect taxes? Properly drafted. These deeds generally avoid present gifts and preserve a step-up in basis at death in many states. Confirm with counsel and your tax pro. Update homeowners insurance after recording so coverage aligns with title. Can I keep renting a room to family? Yes. Use a written lease at market rate and separate payments. Deposit security properly, keep receipts, and include it in the proof folder. If the tenant also provides care, combine a fair lease with a caregiver agreement for clarity. What if we already made gifts? Inventory 5 years. Attach proof of value received, if any, and have counsel compute a likely penalty. Then plan a lawful bridge for those months. Convert future support into market-based contracts. Don't hide it, package it. Does a revocable living trust protect the house from recovery? Often no. Revocable trusts avoid probate, but some states still reach trust assets for recovery. An income-only irrevocable trust is different. Ask counsel how recovery works in your state and title accordingly. Can VA or other benefits conflict with Medicaid planning? They can overlap. Coordinating benefits, income rules, and asset moves takes precision. Bring all benefit letters to counsel and let them sequence the plan so one program doesn't accidentally disqualify another. Case studies, 3 paths that save the house. Let me show you exactly how this plays out with 3 real-world style paths. Different timelines. Same goal. Care gets covered, the spouse or family stays stable, and the house doesn't become the checkbook. First, the early planner. Jane, 68, widowed, healthy, and practical. She met with counsel after a close friend's nursing home bill hit $11,000 a month. She didn't need care. She wanted options. Her plan was simple: an income-only irrevocable trust for her home and a modest brokerage account. She kept full use of the house, collected trust income from the investments, and named her 2 kids as remainder beneficiaries. We recorded the deed into the trust, updated homeowners' insurance to match title, added pods on our bank accounts, and built the proof folder: deed, insurance, 60 months of statements already trickling in, and a 1-page index. What changed? The 5-year clock started. She kept living her life. For years in, she sold the house inside the trust because stairs got annoying. The trustee sold at market. Proceeds stayed in the trust, and the trust bought a single-story condo. Nothing detoured through Jane's personal account, so no look-back issues. At year 5, the trust's principal sat outside her countable assets. The condo remained available for her use, and all beneficiary designations matched the plan. When her health changed at 74 and she needed memory care, her application file was fast. Income proof, trust statements, deed history, and 5 clean years. Result: eligibility without a scramble, condo preserved inside the trust, and no probate fight later. Lesson: start the clock while you're healthy, fund it correctly, and let time do the heavy lifting. Second, the mid-window planner. Carlos, 79, a retired mechanic, slid into crisis. He'd been helping his daughter with $800 a month for 2 years. No receipts, no contract. He also sold a pickup to a nephew for far below book value. Nice kid, wrong paperwork. Then a fall led to rehab, and the facility asked who'd be paying next month. Inside the 5-year window, we moved straight to damage control. We froze gifting and built a look-back timeline with bank statements highlighting each transfer. We converted ongoing aid into a real caregiver agreement at fair market rates, set timesheets, and switched to checks with memo lines. For the undermarket truck sale, we pulled comps, photographed the rust and repairs, and got a mechanic statement to support condition. The state accepted a reduced fair value that trimmed the gift portion. Next, we used smart spend downs: grab bars, a ramp, better lighting, a lift recliner, hearing aids, dentures, and an irrevocable funeral arrangement allowed in estate. Every invoice and photo went into the proof folder. We also documented a modest rent agreement when he moved in with his daughter between rehab and placement, so money flowed at market value, not as help. The penalty math still landed. Several months of ineligibility due to past gifts, but we knew the number before we applied. We built a lawful bridge for those months, so facility bills were covered, then filed a tight application with a clean story from the day. We started papering. Result: the state approved after the penalty period. The house remained in his name aligned to a TOD deed for probate-free transfer, and the family avoided a year of denials. Lesson: you can't erase history, but you can stop digging, convert help into documented services, and shrink penalties with fair value proof. Third, the crisis couple. Ruth and Sam, 76 and 78. Sam needed nursing home care quickly. Ruth remained in the home. They had one paid-off house, $240,000 across bank and CDs, and Social Security plus a small pension. Their fear was losing the house and draining everything. We anchored on community spouse protections. First, we identified their snapshot date and gathered statements. Their state's CSRA allowed Ruth to keep a substantial share of countable assets. We allocated the CSRA to Ruth cleanly and spent down the rest on approved items: roof repairs, a safer bathroom, hearing aids for Ruth, and a modest irrevocable burial plan, every expense at market value with receipts. Next, we handled income. Ruth's income was below the minimum monthly maintenance needs allowance. We documented shelter costs and secured an income diversion from Sam's checks to lift Ruth to the MMMNA. Her budget stabilized, lights stayed on, and the patient pay to the facility dropped accordingly. Now, the house. Their state limited estate recovery to probate assets. With counsel, we recorded a ladybird deed, so the home would pass directly to their 2 kids at the second death without probate. That deed didn't change lifetime ownership or trigger look-back. It positioned the home for a clean transfer later in a state where that helps. We updated homeowners insurance to reflect deed language, refiled homestead, and added pods on bank accounts to keep the estate small. Then we built the proof folder: deed, tax bills, insurance declarations, 60 months of statements, income letters, caregiver logs for short-term help, and a CSRA allocation map. Result: Medicaid approved Sam after spend down. Ruth kept the house and protected assets, and their monthly cash flow worked. When Sam eventually passed, Ruth remained secure in the home, and the deed stood ready to bypass probate at her passing under state rules. Lesson: when a spouse stays home, use CSRA and MMMNA rules, title the house to match your state strategy, and keep the paper trail airtight. Pulling the pattern together, all 3 families won for the same reasons. They used fair value, not gifts. They aligned title and beneficiaries to their state's rules. They documented everything: contracts, invoices, comps, timesheets, and statements. And they chose the right tool for their timeline: a trust early, documentation and spend downs mid-window, and community spouse protections at crisis. Your takeaway is straightforward. If you're early, start the 5-year clock with the right trust or deed, properly funded and recorded. If you're mid-window, freeze gifting, convert help into contracts, and spend down on real needs with receipts. If you're a couple, lock in the CSRA, stabilize income with MMMNA, and title the house to match your state's recovery rules. Do those, and you keep the house out of the $500,000 trap. Families meet when timing and paperwork are messy. In a second, I'll give you the 1-page checklist that makes this repeatable. Your Medicaid-ready checklist. Here's your 1-page do it now checklist. Print it, stick it on the fridge, and work straight down the list. The goal is simple: clean titles, clean beneficiaries, clean paper trail, and a ready-to-file folder. Documents to pull today: photo ID, Medicare cards, Social Security, letter durable financial POA with Medicaid powers, healthcare proxy, HIPAA release deed for your home, trust, ladybird, or TOD, property tax bill, insurance declarations, homestead filing if applicable, last 60 months of bank statements for each account, plus current statements for brokerage, CDs, retirement, annuities, and life insurance income letters for Social Security, pension, and any rental income care agreements. Timesheets, mileage logs, and invoices for any home safety upgrades or medical equipment trust documents if you have one, trustee acceptance. And proof the trust is funded: any creditable coverage notices, plan change letters, and prior Medicaid correspondence titles and beneficiaries to verify. House title matches your plan. Trust, ladybird, or TOD deed. Recorded non-retirement accounts show pod/TOD or trust as beneficiary. Never estate, retirement accounts, life insurance, and annuities list. Correct primary and contingent beneficiaries. Homeowners insurance reflects correct titled owner or trust. And coverages are current contracts and fair value proof. Caregiver agreement at market rates with start date, duties, hours, and payment method. Rent or personal care agreement if living with family. Set deposits, monthly payments. And itemize what's included: bills of sale, appraisals, photos, and mechanic statements for any vehicle or property transfers, invoices, and receipts for safety. Upgrades, medical, dental, and vision spending. Include before/after photos for homework if there was a loan. Add a promissory note with interest and a real payment schedule. Or mark as gift exposure bank and payment cleanup. Freeze gifting. No cash withdrawals. Switch all recurring expenses to checks or ACH with memo lines. Reimburse relatives only with receipts and a matching check. Staple or scan together. Start a monthly ledger. Date, payee, purpose, amount, and proof file name, proof. Folder setup, paper and digital, mirrored identity and powers, real estate and insurance financial statements. 60 months, income and monthly bills, care documentation, and spend down receipts, coverage notices, and plan changes, trust and estate planning name files with dates first, 2025-04-01_bank_STMT_checking.pdf. Add a one-page index at the front so anyone can find anything in 30 seconds. Phone script to book the right attorney. We're preparing for long-term care. We need a state-correct deed or MAPT analysis, Medicaid powers added to our POA, a beneficiary and titling audit, and help mapping our 5-year look-back timeline and proof folder. Can you confirm this state's home equity limits, estate recovery scope, and which deed strategies your office records regularly? Attorney meeting agenda. Bring 1 page per asset owner name, titling, beneficiaries, recent balance, and desired action house. Current deed copy, insurance, tax bills. Ask for state-specific deed versus trust recommendation. Look back timeline. List of transfers, payees, amounts, and any available documentation. Spousal planning. Snapshot date, CSRA estimate, MMNA eligibility, and spend down plan. Quick start this week. If you only do 3 things, update or execute a durable POA with explicit Medicaid powers and your healthcare proxy, record the correct deed or sign, and fund the trust the attorney recommends, build the proof folder shell, and drop in your ID, deed, insurance, the latest statements, and 1 month of caregiver logs or receipts. Ongoing habits. Friday file drop, scan new statements, logs, and invoices. Monthly ledger update. Tag unusual transactions. Annual 10-minute check. Titling beneficiaries, taxes/insurance, and a quick transfer audit. Trigger list to call counsel. Moves, sales, refis, new caregivers, major gifts discovered, deaths, marriages, or state rule changes. If you remember nothing else about this checklist, remember this: titles, beneficiaries, contracts, and receipts. That quartet turns a stressful review into a short approval. Your move is simple. Start the 5-year clock if you can, or start clean damage control if you're inside it. Documentation and fair value win. Want the advanced playbook? Subscribe for the deep dive series. Then watch the companion Medicare Penalties video next so you don't pay lifetime surcharges. Share this with one family member today. Saving a house often starts with one focused conversation.